Well, with me this morning ahead of the president's speech on financial regulation is a banker who has plenty of experience in everything from mortgage-backed securities to distressed situations. Daniel Alpert is a founding partner at structured securities firm Westwood Capital. Dan, good to have you back.
Good to be here.
You've got a lot of opinions, views about what to do with regulation. Let's detail first what you expect to hear from Obama today. I mean, we're not expecting any new news, but the selling points of this is going to be what?
He is going to continue to advance the notion that unless we get bank capital requirements, bank risk-taking, and pay and regulation under control, we're going to have another crisis like this erupt again, probably sooner than everybody thinks.
And is that true?
Well, I do believe that we've gone through a period of roughly 30 years of massive deregulation that ultimately, in the last sort of iteration of that, starting in 1999, left the financial system pretty much devoid of oversight. I mean, when the last vestiges of Glass-Steagall were removed, and I'm not a fan of reintroducing Glass-Steagall, but when the last vestiges were removed, effectively you created a situation where commercial banks were competing with investment banks. The commercial banks enjoyed insured deposits as their chief liability, and the investment banks had to lever up through the roof in order to be competitive.
In order to get those returns, right. Okay, so given that then, you think one of the answers is raising capital requirements?
I think that's true across the board. Look, people got used to these very, very narrow capital cushions in the last 25 years, but you go back to banking in its classical sense. You had banks, 80, 90 years ago that had 24%, 25% capital, and people made money in banking. I'm not suggesting that we need to go to that level, but I would be very comfortable with 15%
So you're skeptical about those who say, look, if we have to raise more capital or we have to keep more capital, then we're not going to be able to make any profit.
Well, that's very interesting, isn't it, right? So you have two arguments from that side. One is, our money's going to get a lot more expensive if we have to make more if we have to get more return in order to cover our capital. The answer is yes, probably, and that's probably the way things should be in order to have financial prudence in this country. But the other thing is, our shareholders won't make a lot of profit. Here's the problem. We license banks. We give banks the ability to access the discount window. We insure their deposits. And at some level, banks have to be beholden to the government and the people who are actually providing that coverage. And when they say, gee, you really should be concerned about our shareholders, I think the Fed is learning to say, not really.
Well, what about the taxpayers, right? Okay, so Dan, this particular bill itself, as it goes through the Senate, I mean, when do you expect it will pass, just in your view?
Well, I think that, this is a momentum thing, just like with healthcare. The momentum's back. The Goldman case, which, I'll take the president at his word, he didn't influence at all, which I believe is actually true, is certainly putting this front and center again, as are several other things that have come up recently. The market's rallying, so there is this sort of undertone of, wow, the banks are doing pretty well. Financial institution system is doing pretty well. And it's becoming, and we're heading in towards an election. So the best time to do this is now, and I think it will happen in the next few months. Certainly,
strike while the iron is hot, essentially.
I think there'll be a bill before summer.
Okay, all right, Dan, good to have you with us again.
Good to be here.
Dan Alpert of Westwood Capital.